the XRP community. They really are a bit of a cult. They are dedicated people, and rightfully so. There are a lot of XRP wallets, I think more than 6 million out there.
What if I told you that one approval, just one, could send shockwaves through the XRP ecosystem unlike anything we've seen before? No, not another airdrop, not a random exchange listing. I'm talking about the one thing that turned Bitcoin from a speculative coin into a trillion-dollar asset class: exchange-traded funds, ETFs, the three letters that flipped Wall Street's stance on crypto overnight. We've seen what happened when spot Bitcoin ETFs went live. Billions flooded in. Institutional investors who once laughed at crypto suddenly started buying. Ethereum followed, and its ETF listings are already reshaping the market. So the million-dollar question now is, what happens when XRP gets its own ETF? Does XRP finally explode past its long-awaited ceiling? Or does institutional money tame it, turning it into another Wall Street-controlled asset? Today, we're breaking down how ETFs could affect XRP's price, the mechanics, the math, and the hidden risks nobody talks about. Stay till the end, because this might just be the roadmap for the next major XRP bull run, or the reason you'll want to double-check your exit strategy. Let's start by stripping away the buzzwords. What is an ETF, and why does it matter so much for crypto? An ETF, or exchange-traded fund, is essentially a basket of assets that trades on traditional stock markets. So instead of holding XRP directly, investors buy shares of a fund that owns XRP for them. For retail investors, that means easy access. No wallets, no private keys, no exchange accounts. For institutions, the real whales, it means exposure without regulatory headaches or custody risks. Every dollar that flows into an ETF requires real XRP to be bought and held by the fund's custodian. That's where the price impact begins, because unlike leverage trading or derivatives, these ETFs need physical supply. They go to the open market, buy XRP, and lock it in cold storage. And when the fund grows, that buying pressure grows too. That's why Bitcoin's ETF launch created billions in demand within weeks. We're not talking about hype. We're talking about structured, regulated, real money inflows. If XRP ever gets its own ETF, the same dynamics kick in, but with one key difference. XRP's supply structure is very different from Bitcoin's. So before you start celebrating, you need to understand how XRP's tokenomics could either amplify this price surge or completely mute it. Here's where XRP stands apart from BTC or Ethereum. Bitcoin has 21 million coins. Ethereum has a semi-deflationary model, but XRP, it has a maximum supply of 100 billion tokens, and a huge portion is still controlled by Ripple Labs. As of recent reports, Ripple holds tens of billions of XRP in escrow, releasing roughly 1 billion tokens each month into circulation. That's a built-in inflation schedule, one that doesn't care about hype cycles or ETF news. Now, imagine a scenario where an ETF drives massive demand. That sounds bullish, right? But if Ripple simultaneously releases tokens into the market, it can dilute that buying pressure. So while ETFs inject capital, Ripple's structured supply releases could absorb that demand, creating a tug-of-war between institutional inflows and programmed supply. That doesn't mean XRP can't rise. It just means its price response might be smoother, less explosive than Bitcoin's. However, there's another twist: liquidity concentration. A few major wallets control the majority of XRP's circulating supply. If those holders decide not to sell, ETF inflows could create scarcity, forcing prices upward faster than expected. So XRP's fate isn't just about how much demand an ETF creates, it's about who holds the supply when it hits. To predict what XRP might do, we can look at history. When Bitcoin spot ETFs launched in early 2024, over $14 billion in inflows poured in during the first month. The result? Bitcoin hit new all-time highs within weeks. Ethereum's ETF approval followed, attracting over $6 billion in its opening phase, pushing Ethereum's liquidity to levels not seen since 2021. Institutional inflows created sustained price floors because ETFs locked supply while demand kept increasing. But here's the nuance: these effects depend on market conditions. Bitcoin's ETF debut happened during a bullish macro cycle. XRP's timing will matter just as much. If it launches in a risk-off environment, high interest rates, weak altcoin sentiment, inflows could be smaller. But if it lands during a risk-on phase or right after regulatory clarity in the US, XRP could rally like never before. Analysts from Kaiko and CoinShares estimate that even $2 billion in ETF inflows could increase XRP's market cap by double digits, depending on liquidity depth. It's a mechanical equation. ETF buys XRP, supply on exchanges drops, scarcity increases, price adjusts upward. But it's not a straight line, and that's where most retail investors get wrecked. Because while ETFs bring buying power, they also bring something else: volatility liquidity and control. ETFs can supercharge markets, but they can also centralize them. Here's how it works. When an ETF launches, big financial firms called authorized participants handle creation and redemption. They arbitrage between the ETF's price and the spot XRP price. If the ETF trades higher than XRP, they buy XRP and deliver it to the fund, minting new ETF shares. If it trades lower, they redeem ETF shares and sell XRP back to the market. This keeps prices aligned, but it also means large institutions like BlackRock, Fidelity, and VanEck become gatekeepers of liquidity. ETFs can't exist in a vacuum. They depend on regulatory clarity and custodial infrastructure. For Bitcoin and Ethereum, SEC approvals came after years of court battles and surveillance sharing agreements between exchanges. For XRP, the picture's a bit messier. In 2023, a federal judge ruled that XRP sales to retail investors didn't qualify as securities. That gave Ripple partial victory, but the SEC still appeals and scrutinizes institutional sales. Without full clarity, US-based ETF issuers are cautious. They need airtight legal frameworks before they can even file. Custody is another challenge. Any XRP ETF would require licensed custodians, firms like Coinbase Custody or BitGo, to hold billions worth of XRP in secure, auditable storage. That infrastructure exists, but scaling it for institutional-grade ETFs takes time and regulatory cooperation. And that's why analysts believe the first XRP ETF might launch outside the US, in markets like Hong Kong or Dubai, where crypto regulations are clearer and Ripple already has partnerships. That could create a domino effect. Non-US ETF launches first, price reacts, US institutions follow, global demand multiplies. So the real catalyst isn't just ETF approval, it's where and how fast the first one launches. Let's get into the numbers. If XRP ETFs attract $2 to $5 billion in inflows during their first month, a realistic target based on Ethereum and Bitcoin precedents, how would that impact price? Here's the math. At a $30 billion market cap, $5 billion in net inflows equals nearly 17% of XRP's total market value being demanded by ETFs. That kind of demand can trigger supply shocks, especially if exchange balances are low. As of Q3 2025, on-chain data shows XRP balances on centralized exchanges have declined nearly 40% since 2023. That means less sell-side liquidity, amplifying the price effect of every ETF purchase. Combine that with speculative retail traders front-running the ETF launch, and you get a potential multiplier. Analysts at Coinmetrics estimate that for every $1 in ETF inflow, crypto assets can see $3 to $5 in total market cap expansion due to leverage speculation and derivative activity. If that holds true, $5 billion in real ETF inflows could translate into a $15 to $25 billion increase in XRP's market cap, potentially pushing price toward the $2 to $3 range, depending on liquidity. But the story doesn't end there, because ETFs can also trigger the opposite effect when redemptions start. Here's the part no influencer likes to talk about. ETF inflows pump the price, but outflows can drain it just as fast. If sentiment flips or regulators tighten policies, those same institutions can redeem shares, forcing massive XRP sell-offs to maintain parity. That's what we saw during Bitcoin's mid-2024 correction. Billions in outflows from ETFs led to one of BTC's sharpest drops of the year. And since XRP's market cap is smaller, outflows would have an even bigger percentage impact. There's also another risk, front-running by insiders. Large holders could sell into ETF-driven hype, locking profits while retail FOMO's in. This sell-the-news dynamic has been seen repeatedly in crypto ETF launches. So while ETFs might create long-term legitimacy, they'll also make XRP more correlated with institutional behavior. Less of a rebel asset, more of a Wall Street product. And that's the paradox. The very tool that could send XRP to new highs could also make it behave more like a stock than a crypto. If you're tracking XRP's future, here's what to keep your eye on: ETF filings and SEC statements. Any mention of XRP in future ETF applications could trigger early momentum. On-chain supply and exchange balances. Falling exchange supply means higher price sensitivity to ETF demand. Institutional partnerships. Ripple's deals with banks and cross-border payment networks could give regulators confidence, accelerating ETF timelines. Macroeconomic signals. Falling interest rates and rising Bitcoin dominance historically attract institutional capital into altcoins. Custody and transparency audits. If major custodians announce XRP support for ETF infrastructure, that's your early signal. So, how will ETFs affect XRP's price? In simple terms, ETFs are jet fuel. They don't guarantee takeoff, but when the engines ignite, they push markets faster and harder than retail ever could. For XRP, the equation comes down to this: ETF inflows plus legal clarity minus ripple supply pressure equals sustainable price expansion. If XRP can balance those forces, if institutional demand meets a scarce circulating supply, we could see one of the most significant price repricings in crypto since Bitcoin's ETF boom. But if timing, regulation, or internal token unlocks go wrong, ETFs could turn XRP into just another heavily managed asset. Either way, one thing's certain: the next chapter of XRP won't be written by retail traders or influencers. It'll be written by institutions, and ETFs are the pen. So when that first XRP ETF gets approved, don't just watch the charts. Watch who's buying the dip and who's holding the keys.